Well, good afternoon, and welcome to Ask the Experts. I'm Al Dominic, CEO at Bank Director and FinX Tech, and I just want to thank you for joining us this afternoon. I'm coming to you from Washington, D.C. We are about, 2 months out from acquire or be acquired out in beautiful Phoenix, Arizona. We're already, seeing an incredible demand to join bank CEOs, their boards, leadership teams, fintechs, investment bankers, accounting firms, you name it. If you're in the financial sector in a leadership capacity, probably have acquire be acquired somewhere on your calendar. At least we hope you do, because we're really delighted and excited to bring folks back out to Arizona at the tail end of January as we get into February. As we thought about how we might do some new things based on what we've learned over the last few years, we thought we should convene some of the leading attorneys that we know to ask what's on their minds as we hit the last month of 2021 and we start to gear up for 2022. So today's webinar is one brought to you by Bank Director, but it's supported by three exceptional law firms. I just want to thank Barrick Ferrazzano, Covington, and Davis Polk for helping us put this together. So quick housekeeping: if you've been on any of these Bank Director webinars in the past, you realize you've been invited to listen in, so you're automatically muted, which I think is a good thing. But the viewing experience is one that, every platform is different, so I would just recommend that you click on the slide bar at the bottom of the screen to put all the presenters into full screen mode as appropriate. Again, it's up to you how you want to do this, but I find that typically works. For this webinar, we do encourage you to ask questions, and I would simply suggest that you note them by clicking the Q&A button found on the right side of your screen. There's no need to take detailed notes. I do have my pen and paper here, so I might ignore my own advice, but I suggest that because the recording will be shared with all attendees within 24 hours via email, and we'll make this available on bankdirector.com as quick as we can. Last point, if you have any technical issues, just note those using the moderator chat feature, which you can find on the right-hand side of your screen, and we'll do our best to take care of you. So on that note, I'd like to introduce our speakers, and I think the simplest way to do this is to put a face with the name. So when I introduce somebody like Rob Fleetwood, who's the co-chair of the Financial Institutions Group at Barrick Ferrazzano, Kirschbaum, and Nagelberg, I know that Rob's going to click open. He's going to wave at us. He's in balmy Chicago. He's just living the dream. And it's just great to have Rob here. Joining Rob is a partner at Covington and Burling. This is Chris Zascree, and he serves as the co-head of the firm's capital markets and securities practice. He also is co-head of the firm's FinTech initiative. So I didn't think to double check where Chris is. I think he's up in New York.
I'm in New York. That's right, Al.
So you're in New York, I'm down in DC. Covington's got great presence in both cities, so it's our pleasure to have Chris join us this afternoon. And to round out this all-star panel, we've got Luigi DeGangi, who's a partner in Davis Polk's financial institutions practice. Luigi focuses a lot on bank M&A, strategic bank regulatory and financial reform advice, and capital markets transactions. All of these attorneys bring, I think, a really great perspective to what's going to be seen out at this conference, Acquire Be Acquired. And it's because of their input that we've been able to develop an agenda that I think hits the mark for being both timely and relevant. And to stay timely and relevant, we want to ask their opinions on a few things that we're definitely going to hear about in the desert, but we didn't want to wait to make sense of, which is why we've invited everyone to this special webinar today. So, gents, nice to see you. Luigi, you're like me. You're probably still trying to figure out what tie to wear. We've got a little bit of time. Rob and Chris are ahead of us on that count. But I think there's a few different ways that we can spend our time over the next 45, 50 minutes together. There's some big issues, timing on regulatory approval, what's going on when it comes to ESG. Certainly, the merge between fintech and banks is well discussed, but there's a lot of issues that need to be addressed there. I also think, as I talk to different folks, we've got some pending leadership changes at federal banking agencies that will have I think, a pretty interesting impact on bank M&A transactions. So As I was thinking about how we might, start all this, I thought I'd start with Luigi and just talk about the regulatory environment that we're in, because as I think about the CFPB and the OCC and others, there's some new incoming leadership, and that does have some potential impact on the industry that we're a part of. Could you give us a kind of elongated view on what you're seeing and sensing right now as it relates to the audience that would be out in Arizona with us?
Sure, Al, and good afternoon, everyone. I think I'm seeing a lot of uncertainty. Certainly, anytime you have transition at the leadership of the federal banking agencies, there's always going to be a period when there's uncertainty as to the particular direction that a banking agency is going to take. I think that this uncertainty has become, with the passage of time and ever since the last global financial crisis, has become more accentuated because there's been a gradual politicization of the leadership of the federal banking agencies, and therefore probably also a greater likelihood of a change in direction or a change in emphasis at the policy level from one administration to the next, even if at the staff level there may be continuity of personnel. And so as we think about it, bank M&A is likely to be affected by the change in leadership at the OCC or the Federal Reserve, or the FDIC. The fact that the antitrust agencies are now under an explicit executive order to review their antitrust guidelines with respect to bank mergers, we're starting to see, even on pending transactions, the antitrust agencies, and in particular the DOJ, become much more aggressive about asking questions and looking at a transaction. Clearly, the issue of partnerships between banks and fintechs, whether or not fintechs can get a particular type of charter that allows them to operate at the federal level, and the interplay between fintechs and banks and crypto assets is also another major policy issue on which I think there's right now a great deal of uncertainty, and to some extent at the OCC, for example, I won't say a reversal of policy, but a clarification of policy or a change in emphasis in policy compared to the previous administration. And then we'll obviously have to see what there's clearly increased emphasis on consumer issues, consumer compliance issues, and we'll have to see what the change in leadership of the agencies, what that results in. Rich Cordray, who you may remember was head of the CFPB under the Obama administration, is now being rumored as a potential candidate to be the next vice chair of supervision of the Federal Reserve. And so you can expect a much more consumer-oriented focus in that position if, in fact, he is appointed.
So, Luigi, you just gave us about 2 days worth of topics that we could try to unpack. And I love my job, but I'm going to do my best to unpack what you just shared, because, man, I mean, we could go down some rabbit holes. We could go down the decentralized finance space and talk blockchain and crypto and, what's taking place there. And I think we need to. On the, regulatory front, I'm kind of thinking about it from the key issues that bank board should focus on. And as I start to think that, I'm reminded of Rob Fleetwood and some of the presentations he's made at past Acquire Be Acquireds with guys like Al Laufenberg from KBW that really surface some of the key issues that board should be facing. So, Rob, maybe you can help me start to take Luigi's comments and frame them from a board standpoint as it relates to what are some of the things that should be on a board's agenda as it relates to this regulatory expectation or the changes that might be pending?
Yeah, and thank you, Al, and a pleasure to be here and looking forward to seeing everyone out in Arizona. I'm from Chicago, and for a change, I might have the best weather of four of us here on the call. It's beautiful here with sun, and we're 40, which for us in Chicago is great. So looking forward to getting out to warmer weather and seeing everyone. From a board perspective, and Luigi hit on topics that we are hearing about and dealing with on a day-to-day basis, and he covered a lot of ground there. Maybe one thing or something that we're getting some questions on, and that our regulatory folks are talking about, and not necessarily in the M&A front, we can cover that in a minute, but what are some of the kind of expectations that boards need to be aware of as we move into, end of 21 and into 2022. And I'm thankful that on my list, the pandemic and the economics related to the pandemic are a little bit lower on my list. That doesn't mean they're not important, but, something that I think people are starting to conceptualize a little bit. But cyber remains a huge issue that we are seeing more questions from the regulators on, and more expectations, particularly on smaller community and regional banks, on what they are doing. And it seems like we've been talking about cyber for a while, but it is getting down to the smaller bank level. And the FDIC has certainly come out, and there are some podcasts out there and some speeches where FDIC folks are saying, if you're not worried about cyber, then what are you worried about? And that is something that I think all bank boards should be questioning their management about, in terms of defenses. What do they have against hacking, ransomware? What are they doing just generally in their cyberspace? That bleeds in a little bit to BSA and AML, in terms of some of the emphasis on the efforts that are in place with new customers, and dealing kind of with the just general technology issues that are out there. So, that is a topic. Maybe, see what Chris thinks about that, or Al, if you have other questions about that. But
yeah, no, I think it's
something we're seeing.
Yeah, I want to toss it to Chris. I also want to make note, it only took us until the 13-minute and 1 second mark to bring up acronyms. So we have BSA and AML on the table, and I'm sure we'll get more of them. But I just wanted to see how long it would take until we could start doing that. So,
I think the only thing I would say that lots of our clients are thinking about, and I think some of this has been forced at the hand of regulators, and also what they're seeing in the market is, what's the plan for fintech? I think lots of our boards have sat on their hands at times, thinking, well, we don't know what to do about fintech, right? And I think the regulators are seeing that. And I think, as we continue forward, I think smaller banks face challenges around fintech and how they compete with the larger institutions. And adopting a plan and thinking about a strategy for fintech, whether that's a fintech partnership, meaning entering into a commercial agreement, making investments into fintech companies, or even a fintech fund. I think those are things that boards need to be thinking about. If you're not thinking about that, you need to be doing that, because that is how you're going to compete in the future. Lots of us stand on the shoulders of classic bankers, right? Kind of classic commercial bankers, and this is not, sometimes people take this as a criticism, and it's certainly not that. Things are changing in the banking market, right? And we all know that. And fintech, I think, is leading the way of that. And you really need to, if you are running an institution or you're on the board of an institution, having a fintech plan is really important.
And If I can piggyback off that for a minute, I mean, people 5 years ago, 6 years ago, 7 years ago, what is fintech? And we tried to come up with a definition. Fintech now is everything that we all do. And for every board member listening, it's what your bank does. It is what you do. One of the things, and Chris mentioned this, are the fintech investments. There are a number of investment funds out there right now that banks are putting not a huge amount of money in, but they're putting some money in order to get some exposure to some of the new fintech technology and products out there. And that is something, if I'm a board member, I'd be asking my management team about, what are we doing in that space? What limitations happen if we invest in it? What are the risks? And again, we're not talking about huge investments in your investment portfolio. It's an entree into getting new products. And that is something that we've gotten a ton of questions on and looks at in the last couple months. And I'm sure Chris and Luigi have as well.
I mean, it's an incredibly valid point, and I hesitate to say that we need to define fintech, Rob, like you said we did 5 or 6 years ago. But I do think from a bank's standpoint, you can think of the intersection of technology and banking in some really meaningful ways. So you have the disruptive, behaviors. You have the neobanks, which are really just like new versions of community banks like Chime that have these massive valuations. But then you have, technologies that can really accelerate your future. Things that can streamline your account opening. There's things around data and, data governance that still is maturing. I think it's interesting when you start as a bank to think about open banking and embedded finance and embedded fintech. The banks that are going down the banking as a service route, what does that offer? Both the pros and the cons. And so, again, I think you're right to look at this, and I do want to talk a little bit more about, banks and just fintechs in the friendly sense. Maybe this is an easy way to talk about the partnership models that have been discussed in past years. Are those still viable, in your opinions, plural, or do you think they've matured and evolved? Luigi, can I ask your opinion on that dynamic?
Well, I think this plays a little bit into the theme of uncertainty that I was addressing earlier. Clearly, partnerships between banks and any service provider continue to be viable. They always have been. You can have service providers that allow you to do better credit underwriting, more efficient credit underwriting that bring borrowers to the bank. You can also have service providers that allow for better payments technology. The question then becomes, though, if you have the question arises, I think, in the banking as a service, or as some people refer to it disparagingly, rent a bank. It's when you really have a large sort of standalone entity with its own business model that then is really using a bank for the sole purpose of being able to place deposits with the bank on behalf of all of its customers. And whether it's doing so in separate segregated accounts or whether it's doing so in an omnibus account, those are the issues where I think banking regulators become more concerned, and especially when the size of the bank is, say, disproportionately small compared to the size of the entity that is using the bank's balance sheet, because it does raise all sorts of concerns about who really has control over the bank's balance sheet. Does the bank have a real appreciation for the sorts of credit and operational risks that it is taking? Does the bank have an appropriate appreciation of the cybersecurity risks that it may be taking? And of course, everyone's traditional favorites, the anti-money laundering risks. So I think they are viable models, and they will continue to be viable models. But I think that as fintechs, as the companies become larger and partner with smaller banks, a lot of the supervisory and risk management issues that banking regulators are really worried about are going to come to the fore.
So would traditional vendor risk management practices be, the way to frame this, or is that kind of like the stepping stone into something a little bit more nuanced? Rob, what do you think?
I'll chime in on that real quick. I think the traditional vendor management is now fintech management, because every vendor you're dealing with is somehow a fintech company. Yeah. So yeah. I think it's one and the same. And I think there are, like anything, as we evolve in technology, we need to be aware of the risks and aware and have good advisors or good staff folks in your management teams that understand the technology. So understanding that when you enter into the vendor contracts, this, data processing is essentially now fintech.
I think I would just add, picking up on some of Luigi's points, that we service, and we are speaking to folks who have always operated in a highly regulated environment and understand risk management, right? This is an extension of how they were raised as commercial bankers, right? This is risk management and understanding the risks that new business lines bring into their businesses. I don't think it's something to be afraid of. I think the regulators are learning along with some of the institutions out there, even some of the smaller institutions who have been successful in these bank fintech partnerships. And maybe kind of going back to my former point, my first point, there's really a ground war out there over deposits, right? If you look at the deposit stratification in this country, I think 55% of all deposits are controlled by something like, the top 5 banks in this country. So that means there's about 5,700 other banks fighting over 45% of the deposits. Bank fintech partnerships are a way to kind of help banks approach that, right? So if you're looking at kind of your core banking, and understanding that there are different risks, the regulators may be nervous about it. You may have to do some explanation about it. But really, fundamentally, it is your core risk management and enterprise risk management protocols that are going to kind of control this. And as Rob said, understanding the technology and exactly what you're getting into is really important. But I don't think it's anything anybody should be afraid of.
Yeah, and as you guys are talking, kind of like the mental model that I'm thinking of is you've got the challenge at the leadership level. You've got to run your business and at the same time protect it. But then Correct. You also have a challenge to grow it. And I think, bringing it back to this whole acquire, be acquired notion, it's not just M&A as the catalyst for your growth like it was, 5-6 years ago, but certainly that's a component that people continue to explore. I think it's interesting to see some of the, the fintech deals that have been struck for banks, not a ton, but interesting when SoFi comes into the market. Interesting to see, Lending Club and Radius and, what they've been able to do, and watching, some of these businesses really blossom in some unexpected ways. I think that's where boards in particular should be spending more of their time to say, okay, how are people pre-positioning themselves for something that we don't feel comfortable with, but we know is going to happen? And, I think having the appropriate risk is important, but also that growth mindset shouldn't be ignored. And I want to use that as kind of like the leverage point to go back to how banks have traditionally grown over the last 10, 12 years. And it's, by combination. And so the last time we were out in Arizona, we were talking about, the creation of Truist. It seems like a long time ago since, that SunTrust deal was announced, but you think about all the different technologies that they're trying to put into the market, all the different branding, the different mergers of equals that have been, done. So if we can put a timeout on the fintech, because we're going to obviously come back to that, but if we could talk a little bit about the M&A side of things, Luigi did a nice job talking about the regulatory changes that are happening. Can you talk a little bit about the regulatory approvals for M&A? A lot has been written recently about the longer approval times, and I'm just, I'm curious if this has been blown out of proportion. Chris, Rob, any thoughts on this?
We have about 4 or 5 transactions in front of the Fed right now. I think they're doing a terrific job, and I'll let Luigi answer this question.
We all have deals in front of the regulators, so we might not give the best
This is
answer.
guys, this is where you can just put yourself on mute, be answering, and say, "Oh, I forgot to say something."
I do think, in my personal view and from my experience with the deals that we're dealing with, I think some of the fear and the thoughts on the length of time to get a deal approved has been exaggerated a little bit. There are obviously the big deals that we can all point to for examples of why deals are, might be taking longer, and there's the charts on things. But, for this audience, for the typical AOBA kind of audience, I think with community regional sized banks, most of those deals are able to be done with delegated authority at the regional banks for the Fed. They are still, whether it's delegated or not, they're still back channeling with DC, and there is still apprehension with the Fed banks and concern that they're following everything, and there's going to be a slight delay because of that. But if it's a, I'll call it run-of-the-mill kind of community bank, regional bank transaction, I think, to kind of piggyback off Chris's comments, I think they're doing a good job getting things moving along as quickly as they can. There's community groups and, the stuff going on with fair lending, the antitrust issues that Luigi brought up earlier that factor in on that. But those aren't in every deal. And I think they have been highlighted in the media and in articles, rightly so, but I don't think boards should be overly concerned that if they enter into a transaction that they're going to, walk into a 2-year, hellhole of trying to get through the regulatory process in my experience. But Luigi, your thoughts?
I think you guys see interesting deals, so I'm just kind of curious if you could help me think about some of the factors impacting the review. So you've touched on a few, Rob. Are there others that people should just be aware of? Chris, Luigi?
Well, look, I think that what Rob said is absolutely right, and the press has a tendency, sometimes to paint with very, very broad strokes. But there is a difference between transactions that don't require action by the boards or the highest levels of the regulatory agencies. Even transactions that do, the delay is likely to be temporary because, for instance, at the Federal Reserve Board, it's because there's a change in leadership and we don't have a vice chair for supervision right now. Once that situation gets straightened out, the Federal Reserve will resume acting, even the board will resume acting on transactions. And I do agree that the one directional change that may result in greater scrutiny is where deals present antitrust issues. At most small sort of community bank deals, that is not generally an issue, and therefore the fact, even if the antitrust agencies take a more activist approach, I don't think that will delay those deals. Those deals, smaller deals, if anything, I think Rob and Chris are probably likely to come under more scrutiny in terms of whether there are going to be branch closures, whether any, all bank M&A deals trumpet synergies, but there is a concern clearly at Congress and among the banking supervisors now that, does that mean that, in fact, the needs of the community are going to be adversely affected? And so I think we can expect more scrutiny of the convenience and needs of the community factor, even in smaller deals than we have before. But that doesn't mean the deals won't be acted on.
And I think Luigi, I think you hit the nail on the head with the needs of the community, and I would just add that I think if somehow the perception is that communities of color are being negatively impacted, I think you're gonna deals will have additional hurdles to get over if the branch closures are sort of featured in certain areas of cities or certain communities. I think that is something that Congress will be very attuned to. I'm sorry, and the regulators as well.
I completely agree, and I think the community groups, Congress, the regulators don't hear about it if they're not told about it, right?
Right.
And I think the community groups are more emboldened now to go out and make some hay in terms of what a bank has done or has not done in different communities. And that is, in our perspective, and from what we've seen certainly in the Midwest, in terms of what is causing some of the delay and some of the consternation among the regulators with approvals.
Well, as you guys are talking, this is a natural place to introduce the acronym ESG to our conversation. I'm not a big fan of lumping these really massive issues into one. I realize it's not in my control, but on the environmental side, like that's a global issue that has massive ramifications for countries, for economies. You bring it down to the U.S. and you think about communities and, what does the environmental impact have, when deals are being considered, when businesses are trying to grow. The S, the G, those can all stand on their own if we wanted them to. But, we live in a world where ESG is an easy catch-all for a conversation like this. So, maybe the way that we can start addressing it is to look at some of the diversity initiatives that community banks are taking or trying to take so that they're not having to go back if they decide they want to grow in some new areas. What are you all seeing as it relates to that particular issue? Chris, you're off mute, so I'm going to pick on you first.
Okay, sure, no problem. I think I just don't know how to use the mute button properly, so that's why I'm off mute. But certainly we have seen and have received lots of calls from clients of banks of all sizes. How do we think about diversity, right? And if you look at historically how especially smaller banks pick their board members, it was local business leaders who could be additive to the growth of the bank, and there's certainly nothing wrong with that, right? And I think probably hearkened by or spurred on a little bit more by the current administration, who has made this a hallmark of their administration, diversity and inclusion. There is now a hyper focus on what does your board look like, right? And I think boards need to think about start thinking about, okay, who are community leaders now, and is that outside of local business leaders? That local church leaders? Is that local not-for-profit leaders? And thinking about how that can be additive to your bank, I think, is really important, right? And those people are in your community. Like, you can go out and find them pretty easily, like in my view. And get real quality people who can be really additive to your board. So I think we're starting to see that at the smaller banks. At the bigger banks, they've been focusing on this for a number of years, of thinking about diversity and different viewpoints, and making sure people look different and think different than your typical historic board, not just bank board. So I think that's really important to start thinking about. If you're thinking about going public, you really need to start thinking about that. Early, during the IPO process, you used to think about, whether your reporting system was okay, whether your CFO was strong enough, did you have somebody on board who has public company reporting experience, things like that. Now you really have to start thinking about, sort of as the first step, what does your board look like? And, taking the examination of, who, aside from who's independent, who could be my audit committee person, okay, who's diverse here? Who are the female leaders in our community? How can we get them on the board? How do we get people of color on our board? Start taking those steps early, so you're getting quality people onto your board early on, so they can be right in the flow of the IPO. I think is really important.
Yeah. Rob, would you like to add?
Yeah, I agree with what Chris said, and when I think of ESG, it applies differently to different industries. ESG in banking has started with the G and has gone
Sure.
Toward the E. So governance, I think even the small banks are kind of on board with that. Social, I put diversity in the social, even though it might straddle governance and social a bit. Agree with Chris. There is a lot more emphasis what NASDAQ has done, what states have done, including my state in Illinois, what California is doing, what New York's doing, is really putting an emphasis on all companies, including banks, to really focus on this. And if we keep moving toward the E, big banks are now, everything with the big banks is who are they funding, what are they doing from an environmental. That is going to filter down to our smaller banks. And we're already getting clients who are, being proactive in their communication with their customers, their shareholders, the ISSs of the world, et cetera, of what they're doing, not necessarily with lending to companies that might have an environmental impact. They're starting with, okay, what are we doing just environmentally to begin with? It's a small step, but I do think, not to move off the diversity, I think Chris covered it perfectly, but we are going to start moving into the environmental stage of that, even for our smaller, community and regional banks.
Well, Rob, remind us, just for the viewers, out in California, I can't remember, it's two female on the board. The states have different expectations. But
I think California is two on the board within a period of time of going public. Yeah.
Right.
Right. And the NASDAQ expectation.
And like Illinois, for instance, it's a reporting requirement. So in Illinois, companies are expected to report their diversity on their board, not within a requirement, but report it. And then, they've kind of commissioned the University of Illinois to make a study and report back and that kind of thing. So,
and on the NASDAQ side, Al, it was one diverse board member, and diverse is a female, person of color, or LGBTQ, by 8/8/22, or you could make disclosures as to why you don't have that person on the board. And then depending on which of the NASDAQ market you're on, if you're on the select of the market, you're 8/6/25, you have to have two members. If you're on capital markets, you have until 2026 to get two people on the board.
Yeah, and if you're a public company, it's got to be a focus of yours. Absolutely. And I think what non-public board members need to be aware of is, like all things we talked 10 years ago about how everything filters down, it's going to filter down to every bank and every regulated industry in terms of what your board is made up.
What also gives you, again, my opinion is it gives you opportunities to differentiate yourself right now. And that window is going to close. But I think of like a Fifth Third and what they're doing on the environmental side. I think about Huntington and what they've done on the diversity front, with their team as a whole. I mean, it's a selling point to bring in new talent. And when you think of it from a business standpoint, and you think of it from I'm trying to grow our business, and this gives me a competitive advantage over others who are not responding to the constituency that they serve, I just think it makes good business sense. I totally agree, on the regulatory front, on the compliance side, making sure that, expectations aren't just met, but they're exceeded. I think some of the more progressive, institutions have said, look, this isn't, a check the box exercise. This is something that's going to help us strengthen our underlying business performance. And, bring it back to how we started this conversation, I think there's so many different issues. And Luigi, again, you did a great job of giving us a lot to cover. But those issues kind of come back to the state of banking being at a true inflection point. There's a lot of things out of bankers' control at the moment. You can't control your geographical footprint. Probably can't control your scale at the very moment, but you can at least control your business model. And if you want to adjust and shift it, now is the time for you to seriously consider that. And I think that, kind of ties back in with technology, not necessarily just fintech, but, technology and what you should think of and how you can use it to grow. It comes to people and who you're bringing into the bank, who you're partnering with, are you learning from. It goes to the risks that come from not doing things, because there are risks from maintaining the status quo at the moment. So I wanted to take just a pause because we've got a few minutes left. If you're watching this live and you have some questions, feel free to drop some questions in. We'd be happy to pose them to the group. I wanted to come back to the fintech space because I know that is really attractive from a conversation standpoint for most people, and really think about what it is that banks might be looking at as they seek a charter through an M&A deal like the ones we talked about, or how is it that space needs to become a little friendlier given what you're seeing from your clients?
When you say friendlier, Al, what do you mean? The relationship between fintechs and banks, how they view each other, or?
I think, I look at it as, you've got all these different companies whose success is predicated on other success. And so, like, who's the first one that's going to, say, hey, wait a second, I'm going to let you kind of be the early winner because there's a long-term success that comes for both of us. But if you think about fintechs and the funding cycles they go through, they can lose money early on. I mean, they can lose a lot of money early on, but then they're expected by nature of a B or C round to come out of that, flying into a hockey stick. Banks don't have that same luxury of losing money on the front end to take new chances. So I could be naive, but I look at it and there's different economic motives for doing business together. So a bank has to perform on, at least public ones, on a quarterly basis so they can explain their tech strategy and what they're trying to accomplish. Whereas an early stage fintech that might be really interesting can lose money and have a longer runway in the near term, but may not be in business if they can't figure out how to turn it around. And so I think that's one of the rubs, and I'm probably not doing a great job of explaining or asking the question, but I'm trying to set up, banks and tech companies need each other, but their definition of success is not always the same.
It's not always the same. That's correct. And, I go ahead, Rob, if you want to.
No, go ahead, Chris.
I've always described this as sort of like a grade school dance where you had kind of boys on one side and girls on the other, right? And somewhere along the night they realized that maybe they like each other, right? And I think that has certainly happened in the fintech bank world, right? I think the concept of disruptor has sort of silenced a little bit, right, or sort of gone away. And I think, as you just described, Al, banks realize that fintechs are really good at technology. Obviously, they're really good at appealing to certain stratifications of potential customers, right? Because banks continue to struggle to get that next generation of customer. So they're really good at that. And on the bank side, we're really great at customer service. We're really good at risk management. We're really good at kind of compliance and making and those things coming together seem to make a lot of sense. And I think, Al, you said it earlier. We talked a lot about MOEs at the last AOBA that we were all at. Maybe banks need to sort of broaden their thinking about who could acquire me and how can we make this work together. And we roll this up all together, and then we're really a powerful platform together as sort of the fintech on one side, the bank on the other, and rolling that all up is a powerful product. That may be another way to think about bank M&A in the future.
Rob?
Right. There's still the sort of fundamental issue, and Al, going back to your contrasting, how a startup fintech company can fund itself and what its short-term economic performance can be compared to that of a bank. To some extent, that's just purely a function of the fact that one is a highly regulated institution and the other is not. A bank is subject to capital and liquidity requirements. A fintech is not. And a lot of that simply stems from the fact that, but banks are insured depository institutions and they have insured deposits, and therefore they have what you might view as a structural funding advantage, i.e. low-cost, stable retail deposits. But with that advantage comes the responsibilities of having to be managed in a prudent and safe and sound manner. Safety and soundness is not something that an unregulated fintech company has to abide by as a prudential matter. Obviously, none of its shareholders are going to want to lose money, and they're not going to want to violate laws, but they clearly have a different risk tolerance and an ability to manage their own business that far exceeds that of a bank, which always has basically a regulator as a backseat driver. And I think that tension will remain, and is also at the source, I think, of like the acting controller of the currency, Mike Sue's more recent comments about bank fintech partnership models and wanting to ensure that unregulated entities don't. He keeps drawing this parallel between, if you're engaging in a regulated activity, you should be a regulated institution, and you can only be an unregulated institution if you don't engage in a regulated activity. And where those two intersect is going to be the focus, I think, of the OCC and the other banking agencies' policy making over the next few years.
Yeah. Rob, do you have a thought that you want to add?
Well, I like Chris's analogy of the dance, and maybe I remember back in those days, we would wait to hear "Stairway to Heaven" because it was the longest song known, in order to get out on the dance floor, and maybe we're at that point. I think that some of what Luigi was referring to, completely agree with his thoughts. Some of the ease that is now kind of out there are these funds, and there is an ability, and I'm not sure if we lost Al or not, but there is the ability for the fintech companies to partner with banks without the strict partnership that banks are exposing themselves to. They can collectively go in, put money into a fund, have that fund help that fintech kind of get started and give the fintech some legs. That, I think, certainly is something that is part of the bank's apprehension of kind of partnering initially and the impact on earnings they may have, but still getting themselves in the game and getting a foot in the door with figuring out what to do in that respect.
Yes, it looks like Al has had connective issues, so he's working to get back on. So while he's doing that, does anyone else have anything to add?
Well, I'll add some stuff if Luigi and Chris.
Perfect.
Not to play Al's role here. One thing we've talked a bit about the fintech world. I'm a little curious on what your firms are seeing in the crypto front, and what, a lot of our client base are the regional community, smaller banks talking to boards about crypto. We get a knee jerk and a physical reaction to it. And I can appreciate that. But I also think that it's important that banks of all size kind of understand what their competitors are doing and kind of what's out there. Kind of us educating our bank boards on crypto has been a focus. Wondering what you guys are seeing or what questions you're getting on that. The OCC coming out, kind of asking for or telling people they need to get permission to do certain crypto activities with custody and the like. Kind of curious if you're hearing that with your client base as well.
Yeah, look, I think, part of it, this is one of these things where also using the term crypto, it covers an awful lot of ground, which really can be quite different. There's a difference, obviously, between, say, Bitcoins and then stable coins. Stable coins are much more like, almost asset-backed instruments. Then there's a difference between acting as a principal and acting as an agent. There's a difference between being, an issuer of stable coins or crypto assets as opposed to just holding them in custody for others. So I do think we're seeing inquiries and potential proposals from a range of participants in the crypto business, just focusing on banks. I think for the most part, banks are primarily focused on acting as agent, acting as custodian for crypto assets, and then what sort of issues do they encounter in those. With all due respect to Mike Hsu and the OCC, I think it's less an issue of permissibility, because I think that acting as a custodian has always been something that banks can do, and banks can act as custodian for just about anything. I remember a risk manager at JP Morgan who used to say, just don't take collateral you have to feed. But as a permissibility issue, you could do that. So I think it's less a permissibility issue and more, do the risks that are posed by acting as custodian for these assets, are they different in nature from the risks that are posed by acting as custodian for other assets? And I think, the classification of risk is probably not different. You can still have credit risk, you can still have market risk, you can still have operational risk. I think if you're acting as custodian, the greatest risk is operational risk. If you screw up on client instructions and you lose the asset, then what are the consequences? And if the asset is not a physical asset, or is not an asset that is in book entry form on a securities settlement system that's been around for 25 years, but is on some blockchain technology, does that pose a different set of operational risks than would otherwise be the case with technology that people have more experience with? I think those are the sorts of issues that we're being asked about.
The only other thing that we've been asked about, or continue to be asked about, is in investments, at either the bank holding company level or bank level into crypto trading platforms, cryptocurrency related companies, and the risks both from bank regulatory, Volcker rule, issues, and also kind of SEC or commodities rules that we need to be concerned about. And we've been doing a lot of advice around it, and that's just not. It's also not related to banks. Kind of across the Covington platform, lots of companies and lots of different industries seem to be tackling both cryptocurrency and most recently NFTs, given the explosion of the kind of NFT values.
So did I leave you guys for a few minutes and I missed the whole crypto conversation?
We have solved crypto. We described to everyone how blockchain works and what it means. So.
That was I was going to either that or LIBOR. It was one of the two, but I was like, I thought crypto would be more fun. Well,
I think we realized we didn't really need you throughout the course of this. So,
hey, Chris, don't tell anyone, because I think I'm eminently replaceable, and that we can go to Arizona, we can get a lot of different folks to do what I tried to do. I don't know. That's like the bad luck cloud rolls in.
No, Al. Every symphony orchestra needs a good conductor. Everyone knows that.
Well, I don't even know how to say thanks to the three of you, because obviously I plan to be involved with the whole conversation. I did get one question before I dropped off, and it was all around the question of relevance. I think this might be a nice way just to kind of tie everything up. every bank, big or small, has to figure out how to differentiate itself and how to diversify its earnings opportunities and diversify its business behavior. So I kind of think about relevance and how can you, as a bank, think about that concept as we get closer to 2022?
I think I go back to my original point. I think the first thing that I mentioned here was kind of fintech and thinking about how you get that next generation of customer. I think that has been a struggle for lots of the clients that I talk to is, my son is 21 and, how do you get him as a customer of your bank and keep him as a customer? And I think a lot of that is fintech and technology because people of that age are just, they grew up entirely tech driven. And playing into that, I think keeps you relevant.
And I agree with what Chris said. And I think one way to do that is get younger people, get more diverse candidates on boards and in management teams. I'm not going to pretend I know what a 21-year-old or a 16-year-old is thinking or doing. Even though I ask them every single day, I don't think I get a great answer. So having younger people involved in the business decisions, I think is important.
Luigi?
I think that's right. At the same time, and at the, risk of sounding like an old fogey, I can't help but remember back to when Barings went under in 1995 because Nick Leeson, a derivatives trader, was entering into all sorts of derivatives transactions that no one at Barings really understood from a risk or governance perspective. And so the only thing I would add is I completely agree. I think banks have to redefine their client base and in some respects also have to redefine their community as they try to appeal to a broader base of tech-savvy customers. At the same time, I think the challenge for boards and for risk managers is going to be to make sure that they understand the technology and that they understand the risks posed by the technology, because the risks are there. The technology may change, but the risks are still there, and the regulators are still going to hold them to very high risk management standards. And it's not really going to be an excuse to say, well, I know I've got to be relevant and have to do fintech stuff, but I'm not sure I really understand what the technology is actually doing.
Yeah. Great points from all three. And, as we think fintech, I think most fintechs, at least half of them, are just great marketing companies that happen to have a technology product. They just, you can learn a lot if you're willing to open yourself up to some new ways of thinking. And again, I think new ways of thinking is why we're having this quote, Ask the Expert, kind of webinar in advance of Acquire Be Acquired. This is not a substitute for doing this in person. I much prefer, getting on stage and spilling water all over myself as opposed to having my, computer reset in the middle. But this is life, and we roll with the punches. And Chris, Rob, and Luigi, you certainly did I owe you one on this one. So, Jen, it was a pleasure having you participate. As mentioned, we're going to put this up on the bankdirector.com website soon. We look forward to seeing you out in Arizona. And again, on behalf of the entire Bank Director team, thanks for sharing an hour with us.
Thank you.
Thanks, guys.
Thanks, everyone.
Thanks, everyone.